everyone, welcome back to the show. Happy Wednesday. Thanks for tuning in. My name is Mike, and today we're going to be talking about 3 considerations for losing trades. I've talked about a few aspects of what we look for when we're opening a trade, but one of the more difficult things, along with rolling trades or making adjustments, can be determining when we want to get out of a trade and what sort of things that we want to think about when we're looking to get out of a trade. So today we're going to highlight 3 things, and these are the most important things that I consider when I'm looking to close a trade. And I'm going to highlight these with you, and we're going to talk through why they're important to me and why it might make sense when we're looking at different trades over our portfolio and seeing whether we should get out or maybe roll for duration. So I'm going to show you the first 3 things that we're going to talk about today, and we've got them laid out here. So when we're thinking about closing trades, and especially when they're losing trades, there's a few things that I'm thinking about. So the very first thing is going to be directional assumption. I'm going to ask myself, has my directional assumption changed, or is my directional assumption the same? And we're going to walk through a little bit about that. I'm also going to look at the rolling amount for credits. So if I'm looking to roll the trade as opposed to closing out of a losing trade, I'm going to assess the credit amount that I can potentially get. Now, it is much easier to get a credit when we're rolling the same strike into the future for naked options than it will be for defined risk trades. So I'm going to be looking at this from a naked option standpoint. But really the question I'm going to be asking myself is it large enough to even merit this roll? Or are there other opportunities elsewhere that I can move this capital, this buying power reduction that I'm using up for this trade, take this trade off and allocate that capital elsewhere into a higher probability trade? So let's get into the first one, which is the directional assumption. So we're going to lay out a trade for you here. We're just going to look at a short put, hypothetically, and we're going to talk through what might happen over the course of the time frame of the trade. So the very first thing we do is we've got our stock price right here, and let's say I've got a neutral to bullish assumption, so I'm going to be selling a put. So I'm looking at a 45-day till expiration time frame. I'm going to sell an out-of-the-money put, which is just a put that's below the stock price. When we're looking at calls, out of the money would be above the stock price. But for this example, we're just going to be looking at selling a put. I'm going to be profitable if the stock price is anywhere above my short put at expiration. But in this example, since we're talking about losing trades, that's not going to happen. So 15 days go by, and we have a put that's now in the money. The stock price has gone from here to here. My stock price is now below my put strike, so my put is in the money, and I'm going to be seeing a loss at this point. Since there's still so many days till expiration, I'm going to have a combination of extrinsic value, which is time and volatility value, but also I'm going to have intrinsic value. So here I only have extrinsic value since this put is out of the money, but the instant that this put moves in the money, it now has intrinsic value. So I have to take the volatility and time value that I will have with my 30 days till expiration left, and I'm also going to have to add in my intrinsic value, which is going to most likely put this put at a higher level or higher worth than what it was when I originally sold it here. So when I'm selling something, I want it to go down in price to be profitable, but if it goes up in price, I'm going to have to buy it back at that higher price if I want to get out of that trade, which is going to be a loss. So in this example, when this put moves in the money with so many days left, we're probably going to see a loss at this point. And let's say another 15 days goes by, and now we're even deeper in the money. So 30 days have gone by, and slowly and gradually it's been going down and down and down. So the very first thing I need to ask myself is my directional assumption the same? Well, in this particular scenario, it might have changed. I might say that I've been seeing the stock price gradually go down over the course of 30 days, and maybe I'd be more comfortable with just taking the trade off because I'm no longer bullish on this trade. If I had seen something that maybe it came down here and then came up a little bit with 15 days left, then I would say, okay, we're just getting some price action here. We're seeing a little bit of movement, which is totally normal. But when I see something that's completely going against me over the course of time, it might make me change my directional assumption. So when I'm looking at closing trades that are losing trades, the very first thing I'm going to do is assess my directional assumption. So for this example, we're actually going to assume that the stock price is going to go back up. So we're going to go on to the next slide, and we're going to assume that our directional assumption is the same, but I wanted to highlight that just to put that in front of you. If you see something that's going against you, we don't have to force ourselves to be in that position. We can assess our directional assumption, and if it's changed, we can be more than comfortable with just taking off the trade. But for this example, we're going to look at that exact same trade, and we're going to look at rolling the trade now. So instead of closing the trade, I'm going to look at rolling it and see what can happen if I roll that same strike out in time to add some duration to it. So let's say another few days have gone by. The very last one we looked at was 15 days ago. So another few days have gone by. We've got 7 days left on that exact same option. And now I'm going to throw on some values here. So let's say I originally sold that 95 strike put. It's now completely in the money and the stock price is at 85. If my current loss is $900 and we've got about 7 days till expiration left, I know that I would have collected about right around maybe $90 for it, something like that. So how I know that is that if I have a put that's at 95 and my stock price is at 85, I have $1,000 of intrinsic value here. It's 10 points in the money, and since each option contract theoretically is equivalent to 100 shares of stock, we're going to be looking at the loss of $1,000. But if I see a current loss on my portfolio of $900, it's taking into account the credit I received, which is always going to be a good thing. Whenever I take in a credit for selling options, it's going to offset my loss by that amount, by the credit amount. So if I only see $900 of loss, even though I'm 10 points in the money, where if I didn't collect anything, I would be at a loss of $1,000, that's good because I know that I've offset my loss just a little bit. So we're going to be looking at rolling this trade into the future. So what can happen here? So if I look at rolling a credit, so let's say I'm looking to roll this put on the same strike and just adding duration. So all I'd be doing is buying back this short option for a debit and then selling out that same 95 strike. And in this example, we're going to look at adding 30 days to that. So we're going to look at an expiration cycle that's 30 days in the future. And I'm going to look at a rolling credit of 20 cents. So I would have to buy back this option for at least $1,000, regardless of what my loss is with my credit that I'm considering here. When I'm looking at just the raw value of this option, I know it's got to be trading for at least $1,000 because it's 10 points in the money. So when I'm looking at my 7 days to go, there's still going to be a little bit of extrinsic value there. So I'm probably going to be looking at buying back this option for right around $10,010, something around there, or $1,010. So we're going to be looking at just over intrinsic value since there are still a few days left with extrinsic value here. And I'm going to be looking at selling an option that's further out in the money, and I'm going to be getting a credit for doing so, which means if I'm getting a 20-cent credit, whatever value I have to buy back this option for with 7 days to go is 20 cents less than the new option I'd be selling at the 95 strike with 30 more days to go. So that's how it works. When we're rolling something, we're basically buying back our old option, selling out a new option, and if we're able to get a credit for it, it's simply because we have more days to go on the new expiration, which is going to give it more extrinsic value, which is going to boost that value of the overall option. And in this case, we're looking at 20 cents of overlay. So I've got 20 cents more on the new option than what I'd have to pay to close out this option. So I've got a credit of 20 cents and I'm adding some days till expiration. So there's a few things that I need to consider. When I'm looking at rolling this, very first thing I'm going to look at is what is my credit amount? Well, my credit amount is 20 cents and I'm adding 30 days. So at this point, I would have 37 days to go. And if the stock price does not move at all, I would have reduced my cost basis by 20 cents. So my current loss would have gone from $900 to $880 if the stock price had not moved at all. So the very first thing I need to ask myself is that worth it? Is that something that I want to partake in, especially because my option is still going to be in the money and it's going to be mostly intrinsic value. Since it's so deep in the money and I'm only getting a credit of 20 cents of extrinsic value, there's going to be a pretty big differential between the intrinsic and extrinsic value of this option. So for that reason, this option is going to act a lot more like stock because of that intrinsic value. Because there's only about 20 cents there, we're going to be solely relying upon the stock price going from 85 up to 95 to hopefully wipe out this loss that we have. And at the same time, since it's so deep in the money, it's going to have a high probability of staying in the money, which means that it's going to have a very low probability of coming out of the money at the end of expiration here. So really, this is going to act more like long stock because of that intrinsic value there, and it's going to have a low probability of expiring out of the money, which is exactly what we want to happen to, number one, wipe out this loss that we have, but number two, get that total profit that we've received from the credits we received from this trade. So let's go to the next slide and we'll talk about another aspect that I think of when we're looking at these losing trades. So we've got our trade here that we just talked about, and let's say that it was in a tech stock. And I had that $900 loss, and I looked at rolling it, but I was only getting 20 cents for the roll. Because it was so far in the money, I didn't have a lot of extrinsic value there. So I would only have gotten 20 cents for holding that trade for another 37 days, and I would have been solely relying upon the fact that I want that stock price to increase by 10 points to hopefully reduce that loss, totally wipe out that loss, and turn that trade into a profit. So I could have done that. Or what I could do is look for opportunities elsewhere. So a lot of times we see a loss in our position or portfolio and we really hold a grudge against that stock. So we look at that stock and we say, wow, I have the loss in this stock. I need to get that P&L in that particular stock up or else. That doesn't have to be the case. One thing that we could do and consider is instead of rolling this for such a small credit, maybe I would see something in a totally different underlying, something that's totally unrelated and uncorrelated, not positively correlated is what we're really looking for. So maybe I'd look at something in energy. I could see an energy stock that's at 85, maybe it's got really high volatility, and maybe I can redeploy that capital elsewhere. So take this trade off entirely and deploy this put in a new stock. So now I've got a totally new trade, a much higher probability of success here. Yes, I'm not going to be able to totally wipe out that loss on this one trade because there's no way I'm going to collect $900 for selling this 70 put. But when we look at our other opportunities, when we consider the roll of 20 cents, there's probably a big chance that I can collect more than 20 cents by selling this put as opposed to rolling this put that's in the money. So it's just a different way of thinking about it and disconnecting the fact that we have a loss in one trade, but we don't need to recuperate that loss in that underlying. We can move our capital elsewhere and be more efficient with our capital. If I'm able to collect more than 20 cents with this trade and use the same buying power, this one is probably going to be a much better option than holding this one that's in the money, which also has that early assignment risk that we don't really like. So when I'm looking at these different things, I'm also going to look for opportunities elsewhere when I'm considering closing out losing trades. So let's wrap all this together with some takeaways for you. The very first takeaway is, again, we don't have to chase our losers in that particular underlying. We can recover elsewhere. So it's always important to be able to pull ourselves off the table on a certain underlying, wipe ourselves clean of that position, and be able to go into a different underlying or a different sector that's totally uncorrelated and redeploy that same capital elsewhere more efficiently. So when we're looking at rolling, if we don't want to close the losing trade, we really need to consider the credit amount. Is the credit amount worth it to put myself in this position again with a lower probability of success, or should I take that money and move it elsewhere as we talked about here? And again, when we're looking at losing trades, we want to reassess our assumptions frequently. Even if we have winning trades or if we have trades that are pretty much neutral, it's really important to continually reassess our assumptions so that we don't find ourselves in a trade that we don't even want to be in anymore. So thanks so much for tuning in. This has been 3 considerations for losing trades. If you've got any questions or feedback, shoot me an email here or you can follow me at DoTraderMike. Stay tuned though, we've got Jim Schultz coming up next.